Good afternoon, everyone. My name is Michael Naidrich, and I'm one of the founding partners here at Amerivet Securities. We had a very exciting day here in the markets on days like today, and every day I'm happy to be joined by our head of rates, Greg Faranello. Hey, Greg, how are you doing today?
Mike, good to see you.
All right, busy day. Everyone wants to talk about the cut today, but I'd like to know, leading up to the cut, tell me what you were seeing that led to this day.
Sure. So obviously we've had this extreme pocket in the market, equity markets, a lot of fear over the coronavirus, leading up to Friday where Chairman Powell came out and said the Fed was willing to do what it was necessary to support the market. Into the weekend, a lot of chatter about a potential cut this week. I think we walked in Monday. We didn't get a cut, but we did get an announcement that the G7 finance ministers, in conjunction with the central bank's heads, would meet today, which they did. That meeting started at 7 o'clock a.m. New York time. And there was some expectation that if we were going to get a cut, perhaps it would happen before the equity markets open. But the Fed actually came in at 10 o'clock this morning and eased 50 basis points.
So why did the Fed ultimately cut today, in your opinion?
So the long end of the market was screaming for an interest rate cut, right? So we saw an extreme bending between the effective funds rate and the 10-year, the long bond. So when you look at that dynamic in the end and you look at rates across the board, the highest thing on the board, the highest rate on the board was the actual funds rate. So the market was very much signaling to the Fed that it was looking for liquidity here. Equity markets had actually rebounded, but it was largely anticipated, whether it was at the March meeting or an intermeeting cut, it was largely anticipated the Fed would provide some support here.
I know you watched the press conferences very carefully. Any nuggets out of Chairman Powell's comments today?
Sure. I mean, one thing he spoke about is the fact that they are trying to coordinate with the other countries that are being impacted by the virus. But he also said, look, this is what we wanted to do. So there is a sense of coordination. It doesn't necessarily mean everything is going to correlate, right? So the Fed came out, they took some bold, decisive action. Some of the other central banks have said they will do the same. Some have. We'll see some in the future. And, in general, he mentioned the material reassessment to the outlook. The one question that came up is kind of what we've been talking about here today, is the fact that the Fed speak last week did sound pretty calm. Let's see how things play out. And then out of nowhere, we get 50 basis points on Tuesday. So Powell was questioned on that, and his answer was not necessarily clear. He just said, this is what we felt we needed to do. So it feels like the Fed is nervous, and I think they're nervous for good reasons.
So, there has been times in the past where there's been cuts in between meetings. It's not absolutely shocking that happened. There's been times in history where that has happened. It's unusual. But now that we have this 50 basis cut, where does that leave us leading into the March meeting?
So risk assets, right? So we got the 50 basis point cut. Last year, and we've spoken about the period in pocket last year, we look at financial conditions in December of 2018. 10-year notes were approaching 3.5% at the same time that we had a dramatic meltdown in equity and credit markets. Financial conditions, and we looked at that this morning, were much tighter back then and in other periods similar to the global financial crisis than they are now, right? So what I think going forward is it's going to depend on the market's reaction here, and it's also going to depend on the potential spread of the virus. So take the March meeting. We're already priced for 25. We're actually priced for a shot of 50 at March. With risk assets, equities, to your point, we're down 1,000 at one point in the Dow Jones. The 10-year note hit 90, 0.90 intraday. We've backed off 11 basis points from there. It's amazing. So volatility is extremely high here. The uncertainty is extremely high. We really just don't have all the answers. So the market, in my opinion, the market will keep the Fed on edge here in terms of expectations going forward. And the variables around that, like I said, it's going to be somewhat related to the virus. It will be somewhat related to risk assets. But right now, as you and I sit here, the market is calling for more, and they're calling for more sooner than later.
So moving forward, what do you think is the Fed's mandate, and how low do you think rates can go?
So we put out a piece on Monday, market update, expectations going forward. The reality is it seems very likely at this point the Fed is headed back to what they call the zero lower bound, which is zero interest rates. Now, they've spent a lot of time talking about the zero lower bound this week. People that pay close attention to the Fed and the speeches and the Fed talk like we do are very well aware that they have said, and Powell said actually in June of 2019 in a speech in Chicago, he said it's very likely we wind up back at the zero lower bound. So let's not kid ourselves. We're not that far from those levels. The Fed recently has also talked about unconventional measures along the way as they approach the zero lower bound. So they could very well, in conjunction with cutting rates, if they do going forward, they can throw in some unconventional measures along the way to try and support the U.S. economy. So from a central bank perspective, we still view this as an extremely dynamic environment, but the likelihood that rates continue to go lower in this pocket of time is very high.
Well, Greg, on days like today, it's really important that, at our firm, we have someone like you who's able to analyze deeply and, amongst sort of the chaos, to have the calm and do the work and talk to our clients. So we appreciate that very much. Today was interesting this morning. We saw issuances. The backlog is 50 to 75 billion. I guess there was close to 10 billion out there. Who knows what market conditions today happens tomorrow, but we look forward to having you back on if we continue to have sort of this uneasiness in our marketplace. And if any of our clients would like to talk to Greg, please call your client representative and we'll be happy to have a call. Thanks for everything, Greg.
Great, Mike.
Appreciate it.
Thank you.
Have a nice evening, everyone.